why not just go all FANG stocks at this point, or all FANG plus growth stocks? Like, why not just your portfolio is Airbnb, DoorDash, Facebook, Netflix, Google, like no bonds, no hedging, because the Fed is your hedge, right? The Fed's not going to let stocks go down too much without stepping into the market and, getting it back on track. So why bother with things like the 60-40 portfolio or downside protection or things like that? Like, why not just go all growth stocks at this point?
Well, I mean, look, it's a fair question. It's not where I'm at or what I would advocate. It's certainly true that growth stocks have worked like nothing else over the past 10, 11 years, and they worked, during the depths of the COVID crash back in March. Certainly, value didn't help you at that time. So yeah, I mean, it's easy to say, just do all growth, and
Yes.
in a way, it depends on what your age is and what your demographic is, right? I mean, if you're 25 and you're starting off your career and you're maxing out your 401k, you're not going to need that money for 40 years. Certainly a more risk-oriented profile makes sense, as opposed to if you're 60 and you're retiring in 5 years and you're going to need to draw on some income. You don't want to be all in the growthiest part, which is also the most expensive part of the market. Somewhat,
it is.
On,
but this is the traditional way of looking at things. And I understand, young people, you can take more risk. I'm saying, hasn't the Fed eliminated risk such that even old people at 65, and I don't mean to, disrespect our elderly seniors out there, I got love for them, but even folks nearing retirement should just be all in growth stocks. They can get the most out of their retirement because we're in a new era where the Fed has your back.
I mean, I think that the Fed does have our back, but the Fed cannot do it alone. And so I think the way I think of what's happened over the past 9 or 10 months is that, we had the COVID crash basically in March. We had the combined fiscal monetary policy response. I call it a fiscal monetary cocktail. We haven't seen that cocktail very often in the history of this country. You have to go back to the 1940s when the U.S. was joining World War II to get that. But Jay Powell of the Fed has said many times we can't do this alone. When rates are at zero and the Fed's already expanding the balance sheet and they've added $3 trillion to it since March, there's a limit to what they can do. Yes, they can keep rates at zero. And if
but is there?
What's that?
Is there a limit? Because he says that, and then he goes out and launches QE Infinity, right? And so now we've got QE Infinity. We know that the Fed can buy corporate bonds. I mean, there's no one, I don't think, who, and correct me if I'm wrong, doubts that if things get really bad, they'll step in, they'll buy stocks. They've already bought junk bonds, so they can do that. I think that the Fed says they need fiscal stimulus, and it was Mario Draghi was saying this back in 2012. Mm-hmm. So clearly there's more that they can do. They've shown that they will not hesitate to just step all over the Federal Reserve Act and do whatever it takes to keep stock prices high, even if, as we've seen, it doesn't necessarily help the real economy. So like I said, I'm trying to see, I'm playing devil's advocate a little bit here, but this is a real question for someone who's a serious guy like yourself and who advises over these portfolios. Aren't we at a place where things are just changing now, where you have to say, hey, you know what? Why not be all in growth stocks?
Yeah, I disagree on that front. I do think that the Fed, it hasn't run out of ammo, and Jay Powell has made that very, very clear over the recent months. But I think when growth is slow and demographically, we have a very low speed limit for the economy because the growth in the labor force has been declining for years, not just in the US, but in Japan, Europe, China. And that limits how much you can grow. And at the same time, debt to GDP is already well north of 100% and growing pretty rapidly. So you're limited in what you can do. Yeah, you can push rates down to zero, maybe even negative, although I think the experiments over in Europe and Japan show that that really has not worked at all. You can keep expanding the balance sheet. And remember, back in the 40s, the Fed increased its balance sheet tenfold. I mean, that, it's already, the Fed's only done 50%, at this point. Tenfold is 1,000%. So there's certainly more that the Fed can do. If the Fed wanted to buy equities like the Bank of Japan has done for years now, it would require a congressional act. But again, if we get this coordination between fiscal and monetary, which I do think is what is needed, and Japan has sort of gone there already before us.
Right.
And I think it's interesting that, with the recent appointment of Janet Yellen at the Treasury, person, I do think we will see that coordination. I think it will fall shy of MMT and that whole concept, but I do think you need it, because remember what happened after the financial crisis. The Fed printed the same amount of money that it did so far now, $3 trillion, although it did it over a much slower period of time.
It did it over years.
At that point, we also had the Tea Party movement that caused fiscal austerity. The deficit in 2009 was like 10% of GDP. In 16 or 15 or 14, it was down to 3 or 4%. So what the Fed was giving with one hand, kind of the fiscal side was taking away with the other. And the reserves that the Fed created through its QE were basically just sitting idle on bank balance sheets. And this is where one of the limitations of even what the Fed is doing in all the capacity that it's doing it doesn't go directly into the economy. When the Fed prints money, they become reserves that sit on bank balance sheets, but those banks then have to be willing to lend those reserves out into the economy. And certainly the last time they weren't, because we were just coming out of the financial crisis.
Right.
But the fiscal bridge bypasses that, because if you give people a $1,200 check, that is directly into the pocket of the consumer, and you don't have to worry about the Fed's QE getting disintermediated or intermediated by the bank. So this is why when you have a lot of debt and you have slow growth and you already have zero interest rates, you really are running out of weapons or out of ammo, and you do need that fiscal linkage to kind of make that picture more complete.
Wow.
Dan, you look like you want to ask a question.
I'm just I'm just taking it all in. So I guess back to the DoorDash example, though, what I can't understand is if indeed a company is losing that much money, like I think you said they lost $150 million last year, right?
Over the first 3 quarters of this year.
3 quarters of this year, excuse me. Is the IPO, is the valuation so high because of what they think it'll do in the future? Or because to me, it's like, why would anybody invest in a company that loses that much money, I guess?
Yeah, I mean, I think part of the story, and of course, these are fresh IPOs, so they have not necessarily been available to purchase before now. But part of it is the momentum play. The kind of the retail day trader jumping on that moves. So there is certainly a speculative element to this. I mean, a company is only worth so much, but I think it's the promise of what we call secular growth, long-term growth. In a world that doesn't have a lot of growth and doesn't have a lot of places where you can put your money and earn kind of a stable income. The bond market is certainly not doing that. The only reason to own bonds these days, in my opinion, is for diversification, as an insurance policy. But even as you get towards zero, I mean, the 10-year treasury is around 0.9 or so. Even then, you start losing that diversification effect, because 0.9 to 0 is not as much runway as 5 to 1, for instance. So it's the promise of structural long-term growth, disruptors, again, the FANG stocks.
Right. So are you saying that, if I'm hearing you correctly, are you saying that these stocks are becoming popular because people have no other choice, basically? Like there's nothing else left?
I think a lot of actions are done out of necessity. Again, think of the demographics, not so much your cohort, but the demographics of people who are trying to save for retirement that don't have a huge time window left to do so.
Right.
In the old days, you could buy bonds earning 5%, and that was pretty good. Now you buy bonds, you get maybe 1.5%.
Yeah.
It forces you out the risk curve. And of course, the Fed's QE is part of that, right? I mean, that's the portfolio channel theory where the Fed forces you out of the risk-free asset into riskier assets. So you buy, dividend yielding stocks, which are, in my opinion, very good, but you're still buying stocks as opposed to bonds at that point.
Yeah, so, but Jurrien, you're making my point here, and I'm trying to get you to argue the opposite point, and you're just making the point, like, shouldn't those people just be in growth stocks? Like, put them 100% in the tech, put them in QQQ. 100%, no bonds, no alternatives, none of that, all QQQ, 100%, and you'll get what you need for retirement because the Fed is here. You got Jelly at the Treasury Secretary Jelly, who no question she's going to give the Fed that 13.3 authorization if things get bad again. You got JP Money churning out the money printer in case things ever get bad. So if things get bad, I feel like you want to own stocks rather than bonds, even in that case.
But at what price, right? If
at any price.
Well, see that's where we go because the starting point, your starting valuation, has a huge impact on the hurdle towards getting to the outcome. And tech large cap growth has worked as a one-way street for 11 years. I don't want to bet against them. I can tell you, like in my personal portfolio, I have what I call a barbell. I don't want to be short those big names because they generate tons of free cash flow, right? And that free cash flow is more cash flow than those companies are able to spend, even after R&D, after capital spending, after dividends, if they pay a dividend. So what do they do with all that extra cash, hundreds and hundreds of billions of dollars? Is they use part of it at least to buy back shares, which is not a direct return of shareholder value to shareholders, but it's an indirect return. And
doesn't that only benefit the executives of the company though?
No, if you own the stock,
I'm sure it benefits.
If you own the stock, it goes up. Okay.
But so think of it this way, right? I'm a big fan. I'm kind of a nerd. I'm a fan of what we call the discounted cash flow model. Right, that's a good way to value or to determine what the proper value is for the stock market. Because often, if we just look at a PE, that can be very misleading. Back in April, the PE was sky high, but that's just because price tends to bottom before earnings. So at these inflection points, the PE ratio is all over the map. But the DCF, you put in a 5-year arc of earnings growth expectations. You look at the discount rate, the interest rate with which you discount those cash flows. And then very importantly, you look at what we call the payout ratio. How much of the earnings that companies generate do you get back? Do you get paid back to you as a shareholder? And
this is all in equities.
Part of that is dividends. Yeah, it's all equity. Part of that's dividend, and part of that is buybacks. Again, buybacks is not a direct return, but it's an indirect return because the trading float gets reduced, and so the value of the stock goes up. The difference between the valuation in the US, which is more growthy, and for instance, Europe and Japan, which is more old economy, is that the payout ratio there is like 50, 60%. Here it's 90%. This is why the U.S. trades at a premium to other countries. So this is the value proposition of these large cap growth stocks. It's not just tech; it's in healthcare, consumer. Amazon is kind of a consumer stock now.
Okay, you're making my argument, man. All QQQ.
Okay, but let me get to the punchline.
Okay, all right.
But the caveat is that if you put that in and you compare the value, which is high. And you compare it to that basket of stocks trading at 15 times earnings or 40 times earnings, it's a much harder hurdle to get across. And that's called, what we call the CAPE model. I don't mean to throw all these acronyms at you, but the cyclically adjusted PE model says that the 10-year PE today is very accurate in predicting the 10-year forward return 10 years from now. And, right now, the PE is high. And so, again, it's a great story. Why would you not want to own Google or Amazon or Facebook? Yes. But you're paying a very high price for it. And that's why I like to be diversified. To me, the other side of the barbell is actually emerging market equities. They're trading at a 14 PE,
EM too.
Whereas the S&P is trading at a 22 PE, and I think the dollar is going to continue to come down. So I want to have that cyclical value exposure that's inversely tied to a falling dollar. So I think there's different ways to make money. And after a one-way street 11-year run, I'd rather sprinkle some assets in other places as well, because no trend lasts forever. And again, it's not just the fundamentals of the trend that you have to look at, it's the price you're paying for it. But buying DoorDash at 20 times earnings that they don't have yet, or 500
what
times
earnings
that they don't have yet, it makes a difference.
I mean, it does, but it only makes a difference if stock prices go down ever, which they won't, because the Fed is here. And if they do, it'll be temporary, and then they'll go right back up.
But remember also, price always leads earnings. It always discounts the future, right? So for instance, right now we're having a monster rally in the stock market off the March lows, and we're even up on a year-to-date basis. And this is in anticipation of the output gap, right? The hole that's in the economy because of the lockdowns and COVID, that gap will get filled. And in my estimation, probably next year it will get filled. The economy went from 100% to 20% back to 70, but it needs to go back to 100. And right now, with COVID cases rising everywhere, it's actually stalling out a bit. So the market's already betting on that 100% next year. So if we actually get to there next year, which I think we will, especially now with the vaccine news, the market may actually not do much because it's already been priced in. So
you're saying it can't go any higher, basically.
It can go higher, but certainly not to the degree that it has been over the last.
Not the ratio that it grew this past year.
Right. So remember, when you talk about all QQQ, a lot of the growth story is in the price already. If it was an undiscovered growth story, that's a different ball game. But like a DoorDash and Airbnb coming out at astronomical valuations, or Tesla, you can look at that company as well. A lot of this is in the price already. And so that's a very important part of investing, is you want to have the good stories, but you want to have them before other people know about them, because then you're getting in on the cheap. And there is no cheap in the FANG world right now.